A strange signal just flashed in the bond market. The same signal that appeared before the 2000 dot-com collapse, the 2008 financial crisis, and the 2020 recession panic. And almost nobody outside Wall Street is paying attention. While ordinary investors obsess over AI stocks, crypto rallies, meme trades, and social media hype, the bond market may already be whispering something terrifying about the economy ahead. Because the 10-year Treasury yield just triggered a warning many analysts say has not looked this dangerous since 2008. And historically, when the bond market starts screaming, the stock market usually listens later. If you invest in stocks, own a home, or care about your financial future, comment the word prepared below. Because what you are about to hear explains why some investors believe the smartest money in the world is becoming increasingly nervous, even while parts of the market still look calm. First, you need to understand why the 10-year Treasury yield matters so much. Most people hear bond yields and instantly tune out. Huge mistake. Because the 10-year yield is basically the heartbeat of the financial system. It influences mortgage rates, corporate borrowing, stock valuations, government debt costs, and investor confidence. Even small moves in the 10-year yield can shake the entire economy. According to Chase Bank's investment research, falling yields often signal rising recession fears and slowing economic expectations, while rising yields can reflect inflation concerns or stress around government debt. And right now, the bond market looks increasingly unstable. In recent weeks, the 10-year Treasury yield pushed back toward critical levels around 4.4% to 4.5%, while the 30-year Treasury approached 5%, levels many investors consider psychologically dangerous. That may not sound dramatic, but in bond markets, those moves are enormous. And what makes this especially important is the pattern forming underneath the surface. Reuters recently reported that the 10-year yield has been trapped inside a giant technical formation known as a symmetrical triangle, where volatility compresses for long periods before explosive breakouts occur. Analysts warned that volatility levels are now near the lowest seen since 1991. Translation? The bond market looks calm, but pressure may be building underneath. And historically, calm periods before major financial moves often become extremely dangerous. That is exactly what happened before 2008. Back then, most ordinary investors believed everything was fine. Housing prices kept rising, stocks looked healthy, unemployment stayed low. But underneath the surface, the bond market started flashing warnings long before the crisis exploded publicly. One of the biggest warnings was the yield curve, and now that same warning system is behaving strangely again. Here is why that matters. Normally, long-term Treasury bonds pay higher yields than short-term bonds, because investors demand extra compensation for locking money away longer. But when investors become fearful about the economy, that relationship can reverse. This creates something called an inverted yield curve. Historically, inverted yield curves have preceded nearly every major US recession in modern history. And before the 2008 financial crisis, the yield curve inverted too. That alone would already make investors nervous. But what is happening now may be even more unsettling, because after long inversions, the yield curve has recently started steepening again, something economists call disinversion. That sounds harmless. It is not. Historically, recessions often begin after the curve uninverts, not during the inversion itself. Wikipedia's recession research summary noted that the last several recessions began shortly after the yield curve returned to positive territory. That detail shocks many investors, because people assume inversion equals immediate recession. Not necessarily. The danger often comes later. And that is why some analysts are becoming increasingly uncomfortable right now. Because the market may be transitioning from fear of slowdown to actual economic deterioration. And honestly, this is where things get scary. The bond market is currently trapped between two terrifying possibilities. Scenario 1, inflation stays stubbornly high. Scenario 2, economic growth collapses. Either outcome creates problems. If inflation remains high, Treasury yields could spike even higher as investors demand more compensation for holding government debt. That would pressure housing, stocks, corporate borrowing, and government finances. Several analysts recently warned that America's exploding debt load could force even higher Treasury yields in the future as bond supply increases. Former Treasury Secretary Henry Paulson even warned policymakers should prepare emergency plans in case demand for US Treasuries weakens severely. Think about that carefully. The former Treasury Secretary is openly discussing potential stress in the Treasury market itself. That is not normal language. But the second possibility may be worse. If yields suddenly collapse downward instead, it could signal investors expect recession, unemployment, and aggressive Federal Reserve rate cuts. That is why bond traders are nervous. The market is coiled tightly between inflation panic and recession panic, and the next breakout could reshape everything. One Reuters analysis explained that Treasury yields are now trapped inside a compressed volatility structure that often precedes violent moves. That setup matters enormously, because Treasury yields influence almost every asset class. When yields rise, stocks become less attractive, borrowing costs surge, and economic activity slows. When yields collapse, recession fears intensify, earnings expectations weaken, and investors run toward safety. Either way, volatility spreads everywhere. And honestly, most retail investors are completely unprepared for that reality. Because many younger investors only experienced markets during low interest rates, aggressive stimulus, and easy money environments. That era may be ending. And the market behavior that worked during the last decade may not work during the next one. That is exactly why the 10-year yield matters so much. It reflects the cost of money itself, and money became dramatically more expensive. Mortgage rates exploded upward partly because of higher Treasury yields. Corporate financing became more expensive. Government interest payments surged. Consumers relying on debt started feeling squeezed. One analysis explained that rising long-term yields increasingly reflect structural pressures including large fiscal deficits, heavy Treasury issuance, inflation uncertainty, and weaker foreign demand for US debt. Those are not temporary issues, those are systemic pressures. The caution is growing. One financial analysis warned the 10-year yield may be breaking down for the wrong reasons, not because inflation is solved, but because economic weakness may be emerging underneath the surface. That distinction matters enormously. Because if yields fall due to collapsing growth expectations, stocks may not celebrate. They may panic. And this is where ordinary investors often make catastrophic mistakes. They see headlines like, Fed rate cuts coming, and assume stocks automatically go higher. Not always. Sometimes rate cuts happen because the economy is breaking. Huge difference. In 2008, the Federal Reserve slashed rates aggressively. The market still collapsed. Because when recession fears dominate, lower rates alone cannot instantly repair confidence. Now, to be fair, some economists argue modern bond markets became distorted by quantitative easing, central bank intervention, and global liquidity flows. And they are right. Even the Financial Times noted that Federal Reserve bond buying may weaken some traditional recession signals. But here is the problem. Even distorted signals can still reflect real fear. And fear inside bond markets matters, because bonds control the financial plumbing of the economy. When Treasury markets become unstable, lending conditions tighten, investment slows, and financial stress spreads quickly. That is why investors are watching 4.5% on the 10-year Treasury so closely right now. Because a decisive breakout higher could pressure stock valuations, hurt housing further, and increase fears about government debt sustainability, Federal Reserve rescues, and smooth recoveries. But financial history is rarely that forgiving. The 1970s taught investors about inflation shocks. 2000 taught investors about valuation bubbles. 2008 taught investors about debt fragility. And 2026 may end up teaching investors something else entirely. What happens when governments, markets, inflation, and debt pressures collide simultaneously? Now, does this guarantee a crash tomorrow? No, absolutely not. Markets can remain irrational longer than most people expect. The economy could stabilize. Inflation could cool, growth could recover. Not with panic headlines, not with dramatic crashes. But with strange signals deep inside markets most people never watch until it is already too late.